Hello, hello. Good evening, everyone. Welcome to the Hidden Edge Podcast, episode 4. I'm your
The
boy,
late night
Sam,
edition.
the
Late
late
night edition.
night edition. And everyone, Kris Patel as well, as you all know. Actually today on Ahmed's stream, they were saying that Kris Patel lost a lot of weight.
I wish, man. I'm working on it.
I was like,
I
I was
wish.
like, let's see. There's one Indian guy who's streaming this, and there's another
Yeah,
Indian dude, and then there's someone else who's not even Indian, but
yeah,
he's Kris Patel.
yeah. They think you're me and I'm you or something. Whatever.
Yeah, I don't know.
Uh,
um,
mm,
anyways, wanted to kind of kick things off. Actually, let's go over a little bit of the agenda. First, we're gonna go over the snow earnings, which is pretty much the premise of this pod for today. And then we're going to go over the FOMC minutes, which really isn't much, but more on a macro scale. And then after that, we're going to watch a little bit of a nice clip and discuss the IWM run, which could possibly be the broadening of the stock market. And finally, we're going to go over some cybersecurity stuff, namely because a particular name had pretty bad sentiment, but has bounced off some levels pretty considerably. I think it was like about 25% that it bounced, actually 30% or something.
Does it rhyme with loud strike?
Um, yeah, something like that. No, not loud check. It should be like foul crike or foul shrike. I
Yeah,
don't know.
yeah.
Anyways, we're also going to get a little bit into cybersecurity too. I don't really think that sector gets really much love, from our
Mhm.
community or from too many people. But I actually think that's probably going to be one of the biggest and fastest growing sectors we're going to be seeing for the next 10, maybe more years. Anyways, we're going to throw a little bit of stuff
Forever,
in the
dude.
middle of that just to see how it goes. Yeah.
I think it's gonna be
So
forever, dude. Cybersecurity is always gonna be a thing. Just gotta make
honestly,
sure
yeah.
that you're. I don't think you ever run into a time where cybersecurity isn't important because every time they come up with a new system to update and do all this other extra stuff, you always have bad actors getting around it somehow, and it's always this game of cat and mouse. So it's almost like, will there ever be a day where we don't need cops? And it's like, no, no, we'll always need police, and that's what cybersecurity firms are. They're like the,
Yeah.
the cops, but they charge you, directly.
It's
So
that they charge you, they're automated. But the good part is that these cops are now cloud native, versus
yeah,
you have to install and centralize all that management internally and then manage it, all the permissions, whatever. Anyway, so we'll get a little bit more into that later and why we think that's a pretty good market to be in as well.
yeah.
So, what did you think? What did you think about Snowflake? Tell me on the news.
They're doing what they're supposed to be doing, but essentially their growth rate is kind of moderating. So,
Yeah.
when you look at companies like Palantir, their growth rate is accelerating. Snowflake's is kind of decelerating and flattening out. So a lot of people are not happy about that. And so they're just not like, oh yeah, we're not going to give it that growth premium that we gave it in the past, regardless of how much share buybacks you announce, regardless of how
3.5
much
billion.
yeah. I mean, in 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 theory, if you look on a valuation basis, Snowflake is much cheaper than Palantir. And then at the same time, if you look at the cash flows, Snowflake is actually utilizing its cash flows to buy back shares at an attractive price, whereas Palantir is just issuing more shares. So his if you want to think about it longer term, Palantir should underperform going forward, and Snowflake should outperform. Also, Palantir kind of benefits from the fact that they have lower comps from last year. So I think a lot of people right now they're definitely celebrating a little, in my opinion, a little too early with this Snowflake slash Palantir thing. Not to say that Palantir is not a great company and it's not doing well, because it clearly is. But yeah, I think Snowflake at this point is a little bit oversold, but at the same time, the oversold part of it is justified, especially when you consider the war that they're waging right now with freaking Databricks and the fallout that they're dealing with because of that. So
So are you a DBX or SNOW fan, or are you a Palantir fan?
no, I'm definitely not a Palantir fan.
I tried to slip that in there. I tried.
The thing is, DBRX has Their luck DBX is lucky that they're freaking private, because the thing is they can do a lot of underhanded shit that Snowflake can't. Like, here's an example. Originally, the acquisition of Tabular was something that Snowflake was going for, but the thing is they have shareholders, so they can't pay an egregious amount of money for it. They have to, at least try to value it in a way that shareholders are not going to look at them funny saying, "What are you, retarded?" So during the negotiations, Databricks is now public. They just said, "Hey, listen, here's $2 billion. Boom, they got them acquired." And now they've got the developers of Apache Iceberg on the goddamn Databricks side, and it's so messed up that this is the kind of like stuff that happens. But I mean, that's how business works, right? So
Yeah,
the big, yeah,
very competitive. It's a very competitive market, right? Like you're going to have a lot of this back and forth. Right now, I would say that it seems that Databricks is owning the market because the biggest thing is that they're private, so they don't have to provide all their financials and stuff to the public markets. And being on the public markets, I think we've heard about this many times in different podcasts, as well as from all the other multiple sources, that the private markets are so liquid. They don't need, like, what'd you say? What was it? How many rounds did you say they had so far? Round I or H of raising funds? Like they could really get as much money as they want from pretty much any private institution or VC. They could just, like you said, they could just get all the money they need just to acquire another company. It's like Snowflake comes in, yeah, let's do like a $1.25 billion, and then Databricks comes in just like $2 billion plus a little bit more. You need a little bit more, here you go. So it really is a tough competition when you think of funding the amounts for all the buybacks, trying to offset all of the SBC that's been happening. Which, another thing I kind of wanted to talk about was the SBC. And the thing is that this has always been a problem, but now the problem becomes pretty profound when their operating expenses increases a little bit higher. And actually, I think their cost of goods sold increased faster than the revenue did in the last year, or compared to the last year. It's not looking so good. And I feel like this is the point where you got to kind of think to yourself, if you are in this position, or if you're thinking about getting the position, is one, are you okay with not buying the bottom? Because no one can time bottoms. I don't care who you are. You can't time the bottom. And if you do, you can't do it consistently. And two, is your conviction strong enough that if this thing goes down another 50%, which if it goes down another 50%, that would be a very cheap price. Right now, it's still trading at almost 10 times EV/NTM revenue to when it was trading around 21 to 23 times just last February, I think. So you have to be okay watching that drop while the entire market goes up. That is something you have to be okay with if you are still staying in this position. Are you still in Snowflake?
Actually, I am not, but the only reason why is because I needed liquidity to buy up the cruise lens. But if it drops low enough, I'll get back in it again. I missed.
I don't blame you, man.
I thought this run was a little bit premature, which turned out to be, but it's fine. I mean, look, if your time horizon is more than like 5 years, Snowflake is going to do just fine. Like you're not going to lose money. Because I mean, they're still performing like they're supposed to, and valuations are eventually going to catch up. The thing is, if your time horizons is more on the short term, hoping for a V-shaped recovery, I don't necessarily think that's the case anymore. I did think that was going to be the case earlier this year when they did have an initial drop. My thinking was that, some of their margins are compressed. Maybe they sandbagged some of their guidance. Turns out they did not sandbag their guidance, and that they actually saw weakness.
They did. They sandbagged it, but not by a lot. It was like 2%. It wasn't a lot.
So now we're kind of on the other end of this. So we have to kind of just, we have to be a little bit smart about it and figure out like, okay, where is Snowflake looking to turn its fortunes around? Like, how are they going to sell more workloads? Like I said, the biggest challenge, in my opinion, going forward for them is this transition to Apache Iceberg, where now all of that data, which was now before stored with Snowflake proprietarily, now they can store it on Iceberg tables, and now that's a huge issue for Snowflake.
I mean, I wouldn't necessarily agree with that, because when you really think about it, most of they have kind of like a parallel mode going on, which previously their strongest mode was the fact that people were storing their data in Snowflake. And now, it was a kind of a sticky place to stick your data in there, and then moving your workloads off was a little bit costly. And then now, of course, they're running into this problem where their biggest competitor just acquired a company, which would bring the data off of Snowflake. But however, even if it's off of Snowflake, it could still be processed by Snowflake data. Like, for example, if the client stores the data in Amazon S3, which is Amazon's storage solution, and they use Snowflake, they can still keep the data in-house and not get charged for that egress rate, right? They can still save some money on that. So it doesn't pose an extreme problem. I would say a big problem is if their revenues were seriously dropping. The numbers, the net retention revenue, meaning that the customers that they had a year ago compared to today, did not increase their cost by 127%, or not increase by about. So their cost compared to last year was 127% of what it was last year. So if that was not the case, because last quarter net retention was 128%. This quarter is 127%. That's pretty good. And Palantir is lower than that. However, it's a little bit different because Palantir is growing very quickly. It's expanding its client base. So that number hasn't really showed up yet because those clients have to be in there for at least a year. So the picture that I'm trying to paint is that it's not that bad. They did sandbag their stuff, so it made it easy for them to have a triple beat. But at the same time, it's not really what you want to see when the S&P 500's earnings are growing and Snowflake is decelerating in growth. So it's kind of an ironic thing, because what was it like? It was just a few weeks ago where it was like, oh, they beat, but they slightly missed in guidance, like something like 10%. Now it's like the bar is raised a little bit higher, where it's like you can't just beat guidance. You got to like blow that thing out of the water to justify your valuation. And that was for expensive stocks. Snowflake didn't come into these earnings being extremely expensive. They were expensive, but they weren't extremely expensive. So I think really it's just a matter of people taking again, it's after hours, so anything can happen tomorrow, right? But what I'm saying is that, like, I think people are kind of really starting to think like the market's going up every single day, pretty much. It recovered 8% since the last 2 weeks, since August 5th. And Snowflake isn't putting up the numbers. Maybe there's opportunity cost here, which is just what you said. You took out your Snowflake money, you put it in CCL because that was a better opportunity, which is, that's totally fine. So I think that's what the market is starting to think. Is there an opportunity cost by staying in Snowflake?
Yeah, unfortunately, I think right now Snowflake it's going to have a few quarters of struggles until they can really materialize that additional revenue from their AI initiatives. I think there's still possibilities that presents them a tremendous upside, but it's not as simple. I think they have just a lot of headwinds ahead of them that make Snowflake a little bit less of an appetizing play to be in, at least in the short term. And I think eventually they'll catch up. But I like I said, for now, I'm more on the side of, hey, listen, there's other opportunities in the market that are probably, way easier targets. But that doesn't mean, by the way, that I'm like advocating to buy Snowflake and dump Palantir. I'm not saying that at all. I'm just saying right now, both companies have their own challenges. Palantir's got its situation with valuations being up there and expectations being really high. Clearly, they're meeting those expectations right now. But one of the things I always see about like the markets when it comes to big tech, not big tech, sorry, with just technology companies, is that investors have this habit of being a little too optimistic too quickly, and they kind of front run a lot of that growth and that development. And then eventually you run into this situation where, the valuations that end up getting reset. So I think that's going to happen to NVIDIA. I think that's going to happen to Palantir maybe next year. So my biggest thing for 2025 is I think eventually AI is going to have a correction. I can't tell you when it's going to happen because that's just the nature of how bubbles, in my opinion, form and work. But I am optimistic about AI long term. I just think there will be a point where people kind of like wake up to the idea and say, you know what, maybe we're not getting as much value from these AI initiatives. And, if there's a place where we need to cut, especially if they're in a recession, maybe some of those AI initiatives will be the first ones to kind of get booted out. And I look at Palantir as an example. So one of the things is that, I don't know if you noticed this, but they've pretty much run out of customers at the top. Now they're running out of customers in the middle and at the bottom. So if you look at the deal
what do you mean?
volume,
Oh, you know, let's
okay,
actually bring it up.
yeah. So if you look at
You want me to bring it up? You got
Palantir's,
it.
no, you get it. Go ahead, bring it up.
Okay,
Look
cool.
at Palantir's earnings.
Yeah.
What you're seeing is there are certain companies with deal values, like they were like at the top, right? These are like your major major players in the world, right? They've kind of run out of those, so they're not getting a lot of new clients at the very top. So now they're kind of moving down. So it's kind of like moving down on the what is that thing called? On the market cap level, right? Which they've hit all the large, they hit most of the mediums. Now they're hitting all the smalls, but then once you finish up with all the small companies, like who's left? You know, now you have to do organic growth within those companies. So it's just it's just one of those things that at least in my opinion is something that just keep an eye on. So if you scroll down, you're going to see like the deal values, that rule of 40, man, that's an amazing statistic. And
okay, that's non-GAAP. Okay, like I
Yeah.
have to announce that rule of 40 is adjusted free cash flow margin plus forward growth. I'll give them that forward growth, but it's adjusted free cash flow. So
a lot of adjustments.
There's a lot of adjustments. All right, and adjustments are very fluffy numbers, but I'm not gonna lie, this company can execute.
Okay, so right here. So you see 96 deals of at least $1 million, right? So now you can see that they went from a lot of deals happening at the higher level. Now it's kind of like starting to come down a little bit. So 27 deals at 10 million. That's 270. So is this as an aggregate, or is it during?
Let's check this out, because FinChat has a way to take a look at these individual segment KPIs. Oh shoot. Yo, what's up, boy? All right. No, they don't have it. I wish they did. Snowflake has it. Okay. So what, let's bring the last quarter up as well. And
just to go there trailing and go to customer count. Maybe we can work backwards.
Wait, so I'm going to bring up last quarter. Okay.
Okay. Yeah.
Okay. It's cool. I like how the file name that they used was, you just replace the Q1 with Q2 and like, boom, you got the previous quarter.
Yeah.
Here we go. Okay, so they got 87 deals last quarter, 27 above 5, 15 above 10, and they got 27. Okay, so what?
Compare that
like
against.
They're doing better.
Compare that, yeah. So they closed right there 87 deals of at least $1 million, right? So they actually increased the number of smaller deals that they had relative to the past quarter, right? And I think this is the trend that's going to keep happening going forward.
But I'm looking at Q2 right now, and I see that because right now you guys are seeing Q1 2024. We just recently reported Q2, and I'm seeing that they have 27 of those 96 this quarter are over 10. So they increased that by they almost doubled it. And then 33, they have over 5. So they added a total, the amount of deals that they closed was 9 more than they closed in Q1. They closed 96 in Q2.
Right.
And then of those, 27 are over 10 and 33 are over 5. So if you aggregate that, that's a 5 difference. Oh, I see what you mean. Okay.
Yeah.
Okay. Had to kind of think about that for a minute.
It's like they're moving downstream. Yeah. That's why I'm saying that, the
deals
you're going to run you're going to run out of Fortune 500 companies that can spend $10 million a year in and the other thing is it says at least $10 million. I don't know what time period that's in, right? Because that's definitely not in one year, right? It could be over a layered period
Oh,
of
you're
time.
talking about the total contractual value. Yeah, they
Yeah.
didn't really talk about that. That's why it's like these two slides, you know, this is Q2 and then this is Q1. Like this kind of stuff, it's like it's nice to look at, but at the same time, this doesn't really give you an idea of where they stand. Probably a better one is to show how many clients are over X number of dollars and then constantly track that. There's a lot of like, I don't want to say bait and switch, but a lot of companies, this is a presentation slide, dude. They're going to try to look as good as they can. Let me actually go to Q2. The one thing I wanted to look at here. Yeah, like I see what you're saying, like commercial customer account. Yeah, this is increasing a lot, but it's like, well, I mean, what are they like? What qualifies as a customer? What dollar amount, what total contractual value? And when I say total contractual value, this is another software term that a lot of you guys need to know about, is that there's annual contractual value and then there's total. So let's say you have a client that signs up for a $300 million deal. Okay, let's just say a $3 million deal over the course of 3 years. That means that the annual contractual value is 1 million. So whenever they give RPO, that's basically the remaining performance obligations, which is basically what's due that isn't billed yet. So if they already billed for this year, that means they already billed 1 million, and that means 2 million is left. So that 2 million is going to be on the RPO for the earnings. So that's something you have to remember. If they sign up a client for 3 million, which is under 5 million for that, all right, then I guess that technically that's a customer, but like what qualifies as a quote unquote customer for Palantir? Is it over 100,000? Is it over 150,000? Is it over a certain number of seats? Is it over, you know, whatever it is? They probably have that in the 10Q. I think about it. Yeah. But I mean, you know, the amount, the pace at which they're growing is pretty good. We did have a bit of a deceleration here. So this is the thing that a lot of people got to recognize, because I did hear a lot of, like, when it comes to Snowflake, is that their growth is slowing. But that's just what happens when a company matures. Their growth usually slows. Not at a dramatic pace. I mean, they're still growing like at 29.5%. year over year.
The problem though,
good.
Sam,
like that's not terrible.
The problem is, like, if you look at Palantir right now, they're projected based on their DCF model to grow 40% year over year, like for the next 5 years. You know, there's no way you can maintain that kind of growth every single year. So
but you can't.
That's where I even messed up with Snowflake in my calculations, thinking that their growth rate would stay a lot, more elevated for a longer period of time going forward, especially because of the consumption-based model that you would always have, like, consumers consuming more. The one thing I didn't take into account is that, even if those RPO numbers look really good, you have to remember that clients right now, they have, like, let's say, a 3-year period where they have certain credits that they've basically bought. What ends up happening is, what happens to those unused credits? Now, the thing is, a lot of their clients are just asking them to be extended, and they're just extending it, saying, hey, just buy like a little bit more for the next 3 years. So a lot of businesses are doing that, so this is where I would say the consumption-based system has some more, like, what's the word? It's a lot more dynamic than something that's more reoccurring, like, seat-based revenue, or just a, straight fee-based revenue system where you have, like, a fixed amount that you're going to be paying for the service or the license,
I'm listening. I was just trying to look for the RPO here. I had on the other sheet. Here we go. So we got the net dollar retention, 114%. So this is actually lower than Snowflake, but at the same time, I'll give it to. Oh, I just opened something in mine. I'll give it to them, because even though it's 114%, they are growing customers at a very high rate. That these existing customers that they already have, a large portion of them were not here for 12 months, which is how they compare the net retention rate. So that number, 114%, I do expect that number to increase sequentially. And if that number increases from 114, you might have yourself a loftier valuation. Like, I'm not saying that's going to happen. I'm just saying that a lot, like what Kris was saying earlier, their comps from last year are much easier than what Snowflake was comparing, because Snowflake came off of a massive growth from 2022 into 2023, while Palantir was kind of like progressively growing throughout that period and accelerating the growth. So it is like a little bit different. But again, these are two completely different companies. When I say completely different, I mean like their niche does not necessarily overlap. Snowflake offers a service. Palantir offers a platform. Very different.
What I want to do is, I'm not comparing businesses against business.
Yeah.
I'm just saying from a valuation standpoint, that's why the market is rewarding Palantir right now, because they're reaccelerating their growth. Whereas right now, Snowflake there's growth is kind of like still sequentially declining.
Yeah, it's declining. Yeah, it's declining. Yeah. The year-over-year number is declining every quarter, which isn't good. Yeah.
And that's normal, you know. But the thing is, this is where things this is how you kind of like can map out the trajectory of a company and say, okay, yeah, you know what, this is kind of like where we're headed. So let me give you guys as an example what I'm trying to say. If you guys, let me just share my screen. So if you look at this is actually, let me go to the other screen. Sorry.
All good.
And this is true for any business. You know, when you have growing growth rates, people are going to value like a growth company, you know? So if you look at Snowflake right now on a quarterly basis, you can see here the revenue growth has gone from 148% when they first IPO'd to now 28%. So you can see that the growth is kind of going down, but it's moderating somewhat, right? So like this quarter that just came, you can see that, you know, they went from 32 to like 28.9. So there's no like stopping this growth deceleration. Eventually, when this growth deceleration stops, that's when this thing will be very interesting to get back into. If you look at Palantir's on the exact opposite end of that revenue growth rate. Look at that.
Which is why they had a valuation.
Yeah, so they moved all the way down. Now they're jumping all the way up. But one of the good things about Palantir right now is that if you compare last growth rate, which was 12.275, it's really easy to comp against that, you know. But like I said, I'm not gonna like downplay Palantir's success here, because Palantir is, you know, doing really well. But you can see here that growth rate reacceleration is why Palantir is getting a huge premium. And I think if somehow Snowflake can get that part of their business more in line again, where they're growing, you know, maybe above the 30s again and hit 35 again somehow, you can see the market, you know, start valuing them like a growth company. So my thing with this is that, you know, Palantir went down all the way to $5-6, and it was justified mainly because that growth rate had gone down to almost 12%. I mean, think about 2023. They literally were growing only 12% year over year. Yes, they had higher comps from the year before, but look at that deceleration. That was huge.
Great comps.
So that's the problem that you run into right now with tech. So right now, tech usually is valued like a growth name, but if you stop growing, you're going to get valued like a value name. You know?
Well, I mean, it's a growth stock.
Yeah,
that's not growing. So it's like,
exactly.
It's like PayPal. It's basically PayPal. That's all it is. It's a growth stock that's not growing. It's like, so you ain't a growth stock anymore, buddy. You're a value stock. Snowflake is guiding for 26%. 26% year-over-year product growth, which is good. But they just had 29.5%. So got it for 26. Let's just say they come up 2% above because they like to sandbag that stuff. 28%. That still is decelerating growth.
I think it's a white screen. I don't know if you see it. There you go.
Are you trying to do a white screen? Oh, you took it
off.
No. Yeah. I mean, you know, I'm not going to sit here and try to sell everyone an amazing opportunity with Snowflake. Like, buy now, guys, while it's low. 2 times your money. It's like, no, I'm not going to do that. I'm going to be realistic. I'm going to say that if your conviction's not there, get the F out. Because you're going to be so frustrated if the S&P 500 continues to outperform the stock. However, if you are invested for the long term or you're looking for good risk reward, all right, this might be a place to park some money in for a small position. Yeah. Again, I only have a 4% position in it, and that's shares and that's leaps. All right. I have time on my hands. I have at least a year and a half on the leaps, and I got when do shares expire?
Never. That's the
There you
point.
go. Yeah, I know. I was like, I mean, I can wait this out, guys. I can wait this out. Bring it. So know what you're in and have the conviction. You got the conviction, then you will have the power to buy when it goes down. If you don't have the conviction, you're gonna get shaken out, dude. You're gonna completely shake it. Snow went as low as like 109 on August 5th, and it had quite a run since then. It was like 30%.
Yeah.
It's like a 30% run, and then it just gave it all back. Well, it gave half of it back. We'll see. Yeah. We'll see how tomorrow goes. We'll see how tomorrow. There's a triple beat, and the earnings weren't that bad. Like it's not like people are like, oh, margin compression, SBC. It's like, well, they kind of guided for everything like that. It's not like SBC is going to fall off a cliff, right? Unless revenue goes up dramatically, SBC is still going to be pretty high. It's not really going to change, right? But so I don't know, 7.5% down. I was a little over the top, to be completely honest. It's trading lower than 10 times historically low valuation. Warren Buffett sold, and then the market continued to rally off the back of that. But we'll see, man. We'll see. They're still not profitable. Their institutional ownership is probably getting taken out a little bit. There's certainly no Palantir, but we'll see. We'll see. Maybe we should move on to FOMC.
Yeah.
All right. So what'd you think?
It wasn't a surprise. We're gonna get a cut in September.
Definitely was not a surprise. I was like, this is the same shit we heard.
Yeah, I mean, some of the stocks rallied a little bit, but this wasn't unexpected. Like everyone kind of knew. The thing though, remember, now that they're gonna start cutting, it's when are they going to stop? And I don't think they stop for quite some time, as long as that data keeps supporting the further rate cuts. Now, what's actually interesting is, and this is something that I'm going to make a prediction and go a little bit bold with it. I think them cutting is going to put us into a recession. Can you believe that?
No.
And it's not going to be a big one, but it's going to be a mild recession. And I'll tell you why. If you're a business, just think of yourself as a business right now. If you know that there's going to be 4 rate cuts this year, do you really want to build a new factory and issue bonds right now? Or are you going to wait until four cuts happen? The last thing you want to do is issue debt and start doing capital expenses because of that. Even as a consumer, if you know that there's going to be rate cuts in a few months, you're not going to say, oh, let me go buy a house right now and take out a mortgage. So you're going to say, oh, I'll just wait a few months until the rates come down, right? So what ends up happening is there's a dramatic, I would say probably just like normal recessions, like a 6 to 9 month lag where all of this pent up demand is going to get kind of like spring loaded, where all these people are going to cut back on spending, and boom, we're going to get a recession. And then the Fed, as it keeps lowering rates, more and more people are going to expect further rates going down. And I think this is where we have to keep an eye on the 10-year, because if the 10-year keeps going down and it could hit the 2s, that'll pretty much confirm my thesis. So we'll see what happens,
dude. It's not going to go to the 2s.
Say that again. So I want to write that down.
It is not going to go to the 2s. Okay, it's going to go to the 2s at some point, but it's not going to go to the 2s this year. Like, that's insane, man. What's that right now?
Year, but
okay, let me share my screen.
Yeah,
it's at 379. 2s. It's a 20% drop. That's more than 20% drop. That's crazy,
listen,
man.
It'll get back down to the 2s. It'll get back to the 2s, bro.
Get out of here.
It was in the 2s before COVID.
It was 0% interest rates. What are you talking about? We're nowhere near 0% interest rates. We're not even, the Fed is even forecasting to go, unless we get some crazy recession, we're not going to go to the 2s in the 10-year. All right, so we are down to 3.801.
Keep laughing, dude. Watch
I am going to laugh.
Man.
Like, that's
unbelievable, right? What do you think the 10-year was the last decade, post-Great Financial Crisis?
Post-Great Financial Crisis, rates were 0.
Right, but then what was the 10-year trading at?
Oh, this is such a bad chart.
Look at the
Okay.
spread between between the two. The Fed right now is going to go from fighting inflation to fighting deflation in about a year and a half to 2 years. You'll see, bro.
Oh no, they're gonna swing the other way for
You're
sure. They're
gonna
definitely gonna swing the other way.
you've got multiple catalysts that are going to be coming our way that's going to have deflationary impacts. Number one, you've got a huge demographic shift from baby boomers to Gen Z. So the thing is, the spending that the boomers had is going to go down significantly over time. Okay, so one, that wealth transfer itself is going to be big, but then also if you look at the number of kids and everything else, the population growth in the United States is I think below replacement levels right now. The only reason why we're even maintaining our population level is because of a positive migration. That's it. So we're literally going into like Japan style deflation. Now, here's the thing: if it was only Japan, it'd be one thing, but China's going into the same thing. Europe is under the same thing. Look at the median age of the working population in all the countries. There are going to be more retirees than there are going to be people working for the next 2 decades. So I would say be fucking very careful, dude.
I don't know,
You know?
dude. I just okay. First of all, the ETF AI bot is on. It's like it's recording us right now. Like that guy said, it's going to go in the summary. Is that a threat? That's a threat. I'll take
Yeah.
that personally. But anyways, I got the thread up over here. This is probably a little more accurate, a little more nicer looking too. Let's go back to 2008. So the 10-year went as low as 2.25%. Coming into it, it was like 4.48. Okay, so there was also ZERP.
Yeah. But then you also have deficits too. Like right now, the US, because of its national debt and deficits, it's going to have to dig its way out. Now, how are they going to do that? They're basically going to have to, lower interest rates, man. I'm telling you, low interest rates are coming, bro.
I
Right
don't
now
think
is
it's
the
going to get
time.
that low.
Right now is the time to lock in all that yield, baby. Eventually,
I don't think 5%.
Another thing is technology is uber deflationary. Okay.
I believe that. I
Yeah.
definitely believe that.
Yeah.
However,
energy is also super deflationary because right now oil and natural gas prices are coming down, right? And I think they're going to keep coming down and stay.
That's because the algos are just playing against the interest rates and the inflation rate. That's the only reason why that's happening. Oil is cheap right now, dude. Oil is totally cheap right now. It's in low 70s. I mean, it's probably going to trend lower to like the 60s or something, maybe the 50s. But like, dude, oil is cheap as hell right now. These companies are going to start like they're going to start pumping in the reserves. They're going to start doing all this stuff, and they're going to like just turn off everything and be like, let's just like sit in this for a little bit. I'm not an oil expert, but I've seen the history with oil. It's like it is cheap right now because that thing is going to always grow no matter what. But I mean, this was 0% interest rate, and then rates were pretty much below 2% for a long time. They came up above 2% in terms of the Fed funds rate. Actually, let me add the Fed funds rate in here. It's already on here.
Look at this. Look, one of the things that we can't escape is demographics, Sam. Take a look at this here, right? Do you see this? This is a chart from what do you call the Congressional Budget Office, right? And you can see here with 2027, that's going to be pretty much the peak. Right now, this giant move up was primarily because of net migration. But if you look at like internal births, look at this. There are going to be less people being born in this country than dying, dude. So population growth is really going to collapse significantly, dude, which means that now you're going to see this huge disinflation wave,
Flood the gates, a lot of work. Open the borders.
No, of course, don't open the borders like that. I mean, bro,
I don't believe this data. Like, I'm sorry. Like, I just don't think this data is 100% accurate.
Bro, it's pretty much accurate around the world, man. I mean,
oh, no, I thought that was US. That was world data.
Huh? No. This is U.S. data. This is the Congressional Budget Office's projections on population growth. So, like right here, you can see. Hold on, let me see if I can make it bigger. No, can't do that. Sorry, let me just try to make it bigger. Okay, And Musk is always complaining about this too, that there's collapse. So you can see here in the dark blue, right? That's births minus deaths. So right now in 2020, we had literally the lowest amount of net births per deaths. So right now there's been somewhat of a bump up in 2025, right? Because of all these migrants that are coming, they're all having kids. That's usually a lot of the birth that's happening.
Yeah.
But if you cut the migrants off, what's going to end up happening is now the number of net migrants coming in is going to be going down. And at the same time, the number of people having kids is going to come down as well. So this is the thing to really watch out for. And this is the thing that's kind of happening in Japan. So if you look at Japan, how they had their deflationary wave. The thing is, Japan did not have any what do you call it, immigration. So their net migration is next to nothing. So if you look at their growth rates, they, after like their population stopped growing in the 1990s, they went into deflation to the point where right now they're fighting deflation actively. So their population flatlined and started to decline. So, it's just something to keep in mind. But like I said, long term, it's super deflationary. Super deflationary.
I get that. Yeah.
China is in the same exact boat right now. So if you look at China's population growth rate, right now, their population growth rate has collapsed to like literally below replacement levels, right?
Yeah,
which is
that
good
makes
for China
sense.
because they're overpopulated. But their economy is going down at the same time, because as these older people start to kind of retire, right? That means that they're not producing anything. Instead, they're going to be taking. And that is what's going to cause a significant decline in their GDP.
Well, I think there's going to be a lot more riots with China, and I think eventually they're going to throw over the regime. That's probably brewing. Obviously that's not really a stable economy. It's very controlled, and it's a lot of hush hush over there. So will China be around for 100 years? Yeah, they'll be around 100 years, but will it still be the same reign? Xi Jinping's getting older, but I don't think he's going to let go of the wheel until he dies. At the same time, it's like, look what's happening to Russia, dude.
Well, there's one other thing I just want to mention too. Like,
go for it.
This drop in population is not unique to the United States, China, and Europe. Okay, this is the entire planet, with the exception of, I think, some sub-Saharan African country. No, even in India. India really? Too is going through less. Yeah, and it's a lot less population growth in India now than the prior years. Hold on one second. Population growth India. Look at this. Hold on.
You're not sharing a screen.
Yeah, there you go.
Oh, here we go. Yeah.
You see that right there? India in the 1970s used to grow at about 2.2% per year.
What's that?
Okay. The United States used to grow about 1.2. Canada used to grow 1.4. Now, the US and Canada, they kind of stabilized and they didn't really grow that much. And now they've gone below replacement, close to below replacement. The only thing is, once again, immigration is keeping their population higher. So you look at Canada, that spike that you saw in 22 is from all that migration. But if you look at India, look at India's population growth rate. It's collapsed.
Look at those COVID babies, man.
That's not COVID babies, dude. That's all the migration. But the point is, if you
people are at home, they got a mate.
If you're seeing the population, the population is really, really something to keep an eye on. So India right now is lucky that it's got some of the youngest total population in the world, so that their GDP right now, they should be in super growth mode with their because they have just the sheer number of people in India should kind of help them develop their economy. The problem is there's a lot of problems in India, to be honest with you.
You probably more I even know about. I have no idea what the problems are there, and we could have an hour pod to talk about that stuff. I don't even know. You'd have to educate me on that sometime. But to be honest, how does that make me money right now?
It doesn't make you money.
How does that make me money? That's capital protection.
The way that the case. The way that I would best phrase this is that imagine right now you could lock in a 5% yield on a US Treasury for 20 years when, and you could do it pretty securely. So in the future, if the treasuries drop to like 2%, 3% and stay there, those treasuries that you have that are long dated treasuries, they're going to appreciate significantly because people are going to be wanting that yield that's very safe in nature. So my thing right now is that you kind of want to be in companies that have the ability to generate yield, don't have any calls coming up, and buy their bonds, long-term bonds. So basically, like, and that's what I'm looking for right now. I'm looking for companies that can generate me a 8 to 12% yield per annum, just based on operations. But at the same time, they don't have any call provisions coming up that basically would cause them to kind of collapse. So as an example, well, not collapse, but basically buy back that debt super cheap. So I would say look at companies that usually do well during periods of low yield and growth, and be invested in those. So.
Yeah, I mean, there's definitely a place in everyone's portfolio to park their money into dividend companies or company bonds, or some of that stuff.
Or REITs.
REITs. I don't want to say the name because that's mostly for the Patreon. But yeah, I mean, there's definitely but also that's wealth protection.
Yeah.
You're protecting your wealth at that point. But if you're someone who's looking for a lot of growth in your portfolio, you just have to take on the risk because you're not going to become rich holding REITs. You're just not, unless you're using spreads.
Yeah, I mean, there's also times where you can utilize this to your benefit. So take a look at this right here. So this is like Verizon. Okay. Now Verizon may not be a sexy name. People look at, like Google. I'd rather be in something like that.
I think
but right
Verizon's
now,
sexy as hell, man.
Yeah. If you look at Verizon,
yeah, go ahead.
If you look at Verizon in 2010, it was trading at $26. Right now, they're trading at 41. So everyone would be like, oh, you didn't really get a big return off of that. Yeah, but if you compound all the dividends and the dividend growth that Verizon had over that long period of time, you actually made out pretty good. So look at this with Verizon from 2010 and on. So at the time, they were giving you about a 47-cent dividend, and it's been gradually increasing. And now it's almost at 66 cents per quarter. So right now, the yield is almost 6.48. So if you kind of like reverse it out a little bit, where, Verizon's not going anywhere, they're almost like a utility. You're locking in a 6.48% dividend, even at $41 right now, with the future dividend growth also going to be coming your way. And also the dividends that Verizon has are actually qualified dividends, So just keep that in mind. Because the thing is, remember, if the S&P 500 is generating, like on average, a compounded annual growth rate between 8 and 10%, which is what it's historically done, you would want to be in something like this over a good period of time, because it's you're going to get that yield, but then you can also keep reinvesting that dividend into further growth,
Okay.
Yeah.
Okay. So one rate cut or two rate cuts?
One. there's no 50 basis point cut in this.
That's interesting. Yeah. I think, oops, I don't want to share that one. Where is CMA Fed Watch? Here we go. Let's see. What does the market say? So the market is saying that there is a 65.5% chance we're getting one rate cut, and there's a 34.5% chance we're getting two rate cuts. Just last week, there was a 25% chance we're getting two rate cuts. Today, it's now 35%. So this number has crept up, specifically today, when those numbers came out for the revisions, whatever, the stupid BS revisions numbers, and the FOMC minutes, which is basically nothing burger. Let's see what happens with Jackson Hole, man. That's on Friday. That's 11 a.m. No, I'm sorry. That's 30 minutes after the market opens. So 10 a.m. Eastern time. Tomorrow is job claims, but I think the market probably really won't react to job claims unless it comes out like as a big surprise. I think all that shit is pretty much done. Now they're just looking at the Fed. It's like, oh, let's look at the Japanese carry trade. Oh, let's look at job claims. Let's look back at the Fed. What's the Fed doing? Like, I think they're back at looking at the Fed. Like I said, Powell speaks on Friday, 10 a.m. Eastern. So yeah, we'll see what happens with that. So wanted to bring up our Lord, our Savior. I'm gonna play this clip for everyone. It's about 5 minutes.
Tom Lee.
In case, yes, Tom Lee. Let's see what Tom Lee has to say.
The broader markets, the S&P 500.
By the way, this was yesterday. This was recorded yesterday, not today. When I say yesterday, I'm talking about Tuesday because I am in Pacific.
Up 8% since that 3% drop on August 5th. Joining me now is Fundstrat co-founder, managing partner, Tom Lee. Tom, good to have you back. Now, I know you're saying that the bottom is in for the market from that early August move. I'm still fixated on your expectations for small caps. I've been talking about them a bit in this hour through the rest of the year. You still think that they could go up 40% by year end?
Yes. John, for small caps to rise 40% means that the PE, the median Russell 2000 stock, goes from 10 times to 14 times. So it's not asking the market to provide some magic and a huge revaluation. It's actually just saying small cap stocks, which have been left for dead largely because the Fed's been tight for almost 2 years, as they start to normalize policy and as mergers pick up, its merger activity has been accelerating this year, and it should really strengthen because it's a sign of CEO confidence. All of these flow through to benefit small cap stocks, and it's not like smaller companies are growing slower. I know people post all these stats about small caps losing money. It's mainly because of the biotech components basically don't make money, and that's the largest cohort of stocks in the Russell. But the Russell 2000 median earnings growth is almost.
Can you pause this? Can you pause this?
And top line.
Do it.
See, one of the things that I'm so glad he mentioned this. If you look at the Russell, just like he said, it has a lot of freaking unprofitable biotechs, about 90% of which never make it. So they end up going away. So unlike the large caps that basically are proven businesses, there's a lot of unproven businesses in the Russell. The other thing is, and I'm not sure he's going to mention this because I haven't seen this clip, but there are still a crap ton of SPACs in there as well that are garbage dog shit companies. If the dog shit companies also play in, that could be bad. So instead of trying to buy the IWM, I think people should try to find companies within the IWM that are outperformers, that are value, that are going to benefit from the rate cuts. And that's exactly what I'm doing right now. So go ahead, keep playing.
Growth is almost 400 basis points. So you're getting better growth, lower valuation. And I think the catalyst is now when the market is convinced the Fed is embarking on a rate cutting cycle.
Okay.
Could happen Friday.
Okay. So if a 40% upward move happens for, say, the Russell 2000, what happens for mega caps? What happens for the broader S&P 500? Do you expect them to have similarly dramatic moves, or is there a major rotation that you're expecting?
Flatline.
What happened?
They're going to flatline. They're not going to do much. They'll grow, but the IWM will outperform them. That's what's going to happen. I mean, it's obvious money's going to rotate, but it's not going to be a lot of money because right now the market is still very uncertain. So you're still going to see value like in Google, Amazon, Microsoft, and those companies, even the other large caps. But the thing is, there's going to be some money, especially new money that's leaving, that's going to end up going to the smaller caps.
Okay.
Well, John, we've already witnessed this happen in large caps. NVIDIA's risen 40% in 8 trading days. So when someone says the Russell 2000, which is made of even cheaper companies, can't rise 40% in the next 5 months, they're forgetting that we've already seen huge moves in the mega caps. I don't think the mega caps have to go down.
Do you expect it to happen in isolation with the small caps is what I'm getting? I know that NVIDIA's done that. Some other stocks have done that themselves. But if you're talking about all of the small, the small caps as an index moving up that much, what do these other things do?
Well, I think that a 40% move in small caps doesn't mean the rest of the market goes down. I just think that's going to highlight that the market is broadening, which is something we all expect, but it's also basically doing a risk reward analysis, which is, look, I think if you can get 18% earnings growth and pay 10 times earnings, perhaps that's a good risk reward. And I think money that's on the sidelines, or people who've been thinking bonds are going to be, and cash is the place you want to stick for the next 5 years, but if the Fed starts cutting, they're going to look for places where there's good risk reward. And I think that's small caps.
Do you need dramatic cuts for that thesis to pan out? Or are there other potholes in the road that you see that threaten your thesis?
Well, a recession would be negative. I don't think the Fed has to make major cuts. It actually just has to, I think the market narrative that would be the best for small caps is the belief that real interest rates are too tight now, 5.5% versus inflation trending towards 2%, and getting rates back down to a neutral rate of 3%. If the market believes that, they don't need the cuts to be front end loaded, but they have to believe we're going back towards neutral. I think that'd be a huge catalyst for small caps.
Okay, now let me ask you about more about mega caps and about the consumer. How important, not necessarily just to small caps, but to the whole market narrative, will NVIDIA earnings next week be?
Well, NVIDIA is really important because it's underpinning really what is driving the U.S. economy, which is a real push towards productivity, using basically digital tools and automation. That's a very important disinflationary trend. And of course, the US companies, all of the big ones are all the US. I mean, it's a global phenomenon that benefits US companies. So I think it's incredibly important. But NVIDIA, trading at 26 times forward earnings isn't that demanding a stock either. So it's not like I would say sell NVIDIA to buy small caps. I think NVIDIA is still a long-term buy.
Okay, so next thing I want to show is this beautiful chart right here. As soon as I get it open, Sammy, hurry up, Sammy. Okay, so next thing I want to show is this one. This is a chart. Do you see this clearly on yours? I mean, actually, maybe you don't see it clearly on yours. But anyways,
I see it.
This is the chart of IWM over
Dude, just
TLT.
Two lines. I hate looking at this damn.
Okay, fine.
The bar.
Fine, I'll do lines. All right, so all right, my bad. All right, so this is a chart of TLT over, IWM over TLT. All right, so the more IWM goes up faster than TLT, or the high, whatever, the more IWM outperforms TLT, the more you'll see this chart go up and to the right. And look at what we've been seeing since the rate hike cycle pretty much ended. We've been seeing IWM slowly outperform TLT. Now, why is this important? This is important because rates are coming down, so therefore TLT is going up and IWM is outperforming it. Now, take a look. Let's take a look at.
Can you go to the axis? Can you go to that y-axis and turn it to percentage? I just want to know what that would look like. That's a freaking great return, man. 60% return. That is fucking nuts.
Okay, now take a look at this. All right, let's see IWM over SPY. That's exactly what I did not want to happen. Okay, so how the hell do I do this? How the hell do I do this? Oh, here we go. I don't.
These pair trades,
do this,
man. That's where the money is. You know that, dude? Like, if you want to make risk-free good money, just do these goddamn pair trades.
Yeah. Oh, exactly.
Pair trades are awesome.
Those are
it's
fun.
like
those are fun.
It's like currency trading,
Yeah. Okay. So I'll do the lines, Chris. I can hear that in your head. All right. So now look at this chart, right? Clearly in a downtrend, right? So this means that IWM is underperforming SPY, right?
Right.
But did we bottom? I don't know. Did we bottom? So you say pair trades, my friend. How about the pair trade of longing both, right? So I have one of the most degenerate freaking plays you could possibly think of. You want to know what it is?
Sure. What's up?
You already know what it is. I already told you what it is. All right, let me just share that screen real quick.
Oh, yeah. I saw that. The TNA calls.
Yo!
That's a degenerate.
This is as degenerate as you could possibly get, man. This is like so degenerate. This is 2% of my portfolio goes to zero. I'm cool with it. All right. I live 2% portfolio. It's risk management at its finest. It is like, it is a degeneracy itch scratcher right here. Right. So I got in this at the worst time you could possibly think of. Now let's take a look at the chart. Let me share the chart real quick. I got in this at the worst possible time, man. And I'll let you know that
you can't get more degenerate than me, bro. Look at that right there. That's real degeneracy.
I can't see it.
I don't know. It's just not focusing. Hold on. There you go. All right, I'll just tell you. I have 362 call contracts on Carnival Cruise Line.
Oh, wait. Don't say the strike. Don't say the strike. Don't say any of that. That's for the Patreon. But that's not degeneracy. That's
it's like 60 grand. That seems kind of degenerate, bro.
That's not degeneracy because that's edge. All right, like that's edge. You did your research, you done your DD and all that stuff, and that's edge. Like, dude, mine is just gambling. Like it's not even anything. I'm gambling off this shit. All right, so I wanted to bring up the IWM. Like I could not have gotten in this at the worst possible time, dude. My timing could not.
I've never seen someone so happy at the mistake.
Because I'm a freaking degenerate. All right, I'm a degenerate mofo, but not with my whole portfolio. Like I know how to manage risk. All right, so let's see, July 25th. Look at this fucking shit. Look at this. And then you know how I felt about it when this was like, I was like, damn, like yen carry trades unwinding, like. I know if I don't buy more right now, then
so did you average down?
I averaged down, my friend. Okay, so the position started as 2% and it went down, so I made it 2% whole again. But to be completely honest, like, okay, so I know it seems pretty degenerate what I'm doing, but I'm doing very well. Like I think I'm performing pretty much on par with the market right now with my entire portfolio, and cool with it. Like I most of my portfolio, 80% of my portfolio is in long-term holdings. All right. When I say long-term holdings, I mean like shares, okay, and ETFs. Like the rest of it is just 20% that I'm literally just like doing calculated trades with, and then small percentage is just degeneracy. And I think it's going to win. I really do think IWM is going to win. It is probably the most hated thing that if it does run, like people are going to hate it, but people are going to chase it because they're just chasing. Yeah. It literally is a play against interest rates, correlations, and the fact that hedge funds need to chase shit. All right, they need to chase stuff because they need to perform good. So. I think it'll do good. And that, I mean, regardless of the fact that I know you say the IWM has like a lot of companies, which is true. It has like a lot of crappy companies in there and stuff, but it don't matter because hedge funds will go in the ETF. They won't get single names if they don't have to. They're going to go in the ETF because it's very liquid. It's very easy to get in there and doesn't require a lot of margin for them to do that. So, we'll see. We'll see what happens.
Yeah, I'm just loading up on my favorite preferred the REIT right now. That's what. Oh yeah.
I don't blame you. You had a phenomenal year this year, and you had a phenomenal year last year. It's like, what more could you ask for? Like when I get to your level, like most of my money will be in I wouldn't say risk-free assets, but like very close to risk-free. Like minimize risk, protect capital, and then like play with 10% of your portfolio.
Yeah.
That's good.
I think this one's a unique opportunity right now to just basically get in, hold it, and just relax. Like I expect that thing to get back to par by next year, which seems to be the case. And especially if we get, 4 rate cuts this year, another 4 next year, you're looking at almost 8 rate cuts, which is what, like 200 basis points, which is good. That means that now a lot. There's a whole thing behind it. So, but the point is right now there's a unique opportunity before the Fed starts to cut to get into these yielding assets and basically lock in that long-term yield. And I think that's something that maybe we could talk about on the Patreon, like exclusive, where we kind of go over a lot of these plays that are out there right now. Because if we do get into a low growth scenario next year, you kind of want to have your portfolio in risk off with yielding assets that are going to do well. Like here's an example. Like I don't know if you've been looking at the regional banks. A lot of them ran really hard this year.
It's
You
just
know, if you
cooling
look,
off. I think it's
yeah,
just cooling off right now. I don't think they
Yeah.
topped out or anything. I think it's just cooling
Yeah.
off. I mean, they've been like having the worst sentiment for a while. They've been
Oh,
massively
dude.
underperforming the market ever since even the bank blowups in 2023.
Yeah.
They've been they need to normalize, you know, for one thing, and then they're going to overshoot it. I
Yeah.
definitely do think regional banks is going to be the place to go for a lot of companies when people want that better than lower interest rates. Because right now those big banks, like they're offering the crappiest interest rates. I got to go with the regionals. I wanted to share this screen here. This is something that Warren Pies. I don't know. Do you know who Warren Pies is?
No.
Okay, he's a pretty good economist. He posts a lot of charts online. More of a macro guy than an individual stock guy, but he's done a plenty.
I saw
of
this. I
research.
think you posted this.
Yeah.
I saw this.
Yeah, I post this in the Discord many times. So he has this chart where it's basically how 10 yields react or play into a first rate cut of a soft landing. So there's a couple of caveats with this, right? Well, actually, let me explain the chart first. So you have your 10 yields. This is actually the bond price of the 10 yield. So this isn't like an actual yield, but just look at the performance of the chart. And this is the yield. So remember, the yields go down, which means the bonds go up, right? So TLT would go up when the 20-year goes down. The 20-year yield goes down. So this is basically saying that leading into the rate cut, yields drop like a rock. This is what I'm expecting. I would say we're probably like 30 days away, right? Yeah, we're about 30 days away from FOMC. So we're probably like around here. We had this massive drop in yields, dude. Like we already dropped like 50 basis points in like the last couple of months, like not even last couple of months, maybe like the last month. Like we have dropped considerably. And I think there's more room to go down. However, if you've been in this trade with me, I've been in TMF calls, and that's not I don't think that's a degenerate trade. I had a lot of edge on my side. I've looked at the positioning of the futures positioning. I've looked at the sentiment. I looked at technical analysis. I've looked at many charts like this. I've looked at correlations. TLT is making its run right now. Getting into it now might be a little bit tough to do, getting into leverage positions, but I certainly think having TLT shares is good. Plus, they pay a dividend yield. I know there's someone in Discord who's doing that as well, and I wouldn't argue against that because honestly, when it comes to TLT, we're pretty much just looking at upside if you're holding for like 1 or 2 years because that's just the direction rates are headed. And I did take about 20% of profit. I'm probably going to take more as I rotated into more of the value positions like we were talking about and possibly more protected assets. So
you want to see
a great run, man. Yeah, go
you want
for
to
it.
see something crazy? Check this out. This is triple B 10-year, triple B corporate debt, not any duration, just triple B corporate debt. Triple B corporate debt right now is actually the effective yield is actually lower than the federal funds rate, which means even the bond market on the corporate side is expecting massive amounts of drops in the federal funds rate. I mean, I'm going back. Look at this. Have you ever in the history, like, let me just see how far back I can go. Never in the history of this data, which is about 25, 30 years, has the federal funds rate been higher than the triple Bs. A triple B is still risky. It's not high grade debt. If you look at high grade debt, like AAA,
I'm surprised the triple Bs pay so low.
Well, that's the thing. It's because right now the market is already anticipating massive rate cuts. Well, the other thing is, remember, this is also like effective yield as well.
Yeah.
So what ends up happening is when there's massive moves, like on the bond side, bonds are not as liquid. You're not going to see a big correlation. So like right now, if you look at 2008, you had bought like literally triple B debt trading almost at 10% yields. At the time, you could have bought a lot of bonds that were yielding 5 and 6% face value, but you could have bought them at 50 cents on the dollar. And that's where I actually made some money. So, if eventually I gotta teach people how to trade bonds, because if you think about it, corporate bonds, especially if you get into the right corporate bonds, all you need is companies to survive, and you could do like a 10x return on a bond plus generate a 100 to 200% yield on the interest. And I know that sounds like that's not possible. Trust me, it's possible.
No, it's possible.
And I've done it
It's
before.
possible.
I've done it before. So let me just add AAA rated corporate debt right here.
And some people lever up in that too. So there's that.
Look at
especially if
this.
you do an IRA account.
AAA corporate debt right now is trading way below the federal funds rate. You see this
that's
right
expected.
here?
That's expected.
The bonds right now, this is what I'm saying. This is why the market is already anticipating massive rate cuts coming our way. So a lot of people are locking in this yield right now on the bond side. Eventually, they're going to be looking for the same yield on the equity side. This is why you want to be in companies like Verizon, because now Verizon could go into the open market and actually issue bonds that are cheaper than the federal funds rate right now if they went into the market and did that. Cruise lines, because they're so over levered, a lot of people are looking at the yield. They're not looking at the yield. They're only looking at the total amount of debt. But the thing is, if let's say Carnival, Norwegian, all these guys, they want to go into the open market, they could probably get much, much lower corporate debt and refinance a lot of the shit that they have on the balance sheet that's actually really expensive. So that's why I'm telling you, one of the things to look at, because no one has done their debt analysis, their credit analysis on some of these cruise lines, that's where our real alpha is. So regardless whether or not we have this recession, right, bro, we're going to do well. We are going to do extremely well.
Well, that's why, that's why I have high conviction in it. I mean, I wouldn't say it's an arbitrage play, but you got two things. You got travel has pretty bad sentiment right now. People everywhere here, people are like, no one's traveling anymore. Like, no, okay, when people are noticing that stuff, like that's when like you pretty much hit near a bottom at that point.
Yeah.
I personally don't think a recession is going to happen. And so once those fears dissipate, then you're going to start to see a lot of people come back into it. We've already seen a bit of recovery as far as valuations go. In terms of a lot of the booking companies, namely BKNG, which is one of my newer core positions, which that's doing pretty well right now. I think I'm up about 10%, and I have a big position in that one. So,
so someone asked about Verizon Leap calls. I have Verizon Leap calls, $32 Verizon Leap calls, and I have.
You still got that?
Yeah, still got some of them. Yeah,
nice.
Those were the perfect time to buy in December. And also at the same time, there's a lot of people in the Patreon that have Verizon spreads, which by the way, do not touch. That thing is we're riding all that shit to the promised land.
Those are the
nice return.
Yeah. I mean, we gotta say right now because like it is not a good idea to buy right now, but they were the 3242s, right? 2026.
Yeah.
For 35 45s. Yeah, if you buy it now, like it's just such a bad idea to buy right now. Like that. Yeah. You're gonna.
I mean, there's still alpha there, but there was a huge. There was a point
the IB is way higher.
Really well.
Yeah. The IB was very low around that time. Like it had the worst sentiment ever. There was so much garbage talking about Verizon,
and it's a low beta stock.
Yeah, it is a low beta stock. It was like the perfect opportunity to jump in, and I got in on it. I get in on the spreads late. So then I just basically bought naked calls when it was around 35, 36, and that thing when I would have never guessed how much money I'd make off of freaking Verizon in my whole life. I would have never guessed that.
Dude, but truest, there's people right now that are sitting on a ton of TFC spreads that are fully priced now. So like they're close to their short leg. So, I've been talking to people, just making sure everything is good. And so, there are unique opportunities in the market to take advantage of disconnects. And I like, dude, you won't believe how many people right now, they're fucking laughing at me. They're like, oh, this guy with this cruise lines. We'll see. We'll see in about a year.
I still remember the Verizon stuff. Everyone was laughing. They didn't get it. They were too much into NVIDIA. They were too much into the growth stocks. But like sometimes you just got to diversify your portfolio a little bit. Like I don't mind having a little bit of diversification. I'm mostly weighted in growth stocks when it comes to single names. So I need to diversify. I need to have something that doesn't correlate, a non-correlated trade. And if it's going to be in something, it's going to be in something that that I lost my train of thought. But if it's going to be in something, then it's not going to be in growth stocks. I got to diversify a little bit, but that's good. That's good. The last thing that we're going to talk about is cybersecurity. And the thing is that cybersecurity, as we were saying at the beginning of the show, it's starting to get a bit of attention. And what's funny is that like a year ago, it really didn't get that much attention. In fact, it got a lot of negative feed because they just thought that, when I say they, I mean the market just thought that like Microsoft was just going to take the whole boat. Like they were just going to take it all, right? And since then, we have had crazy runs in certain cybersecurity stocks, namely CrowdStrike. CrowdStrike, I'm going to bring up the chart right now. Okay, here we go. So, and I've known this stock pretty well. What are we over here? Okay, 2023. So I started buying around here, right? And actually, I started buying like around here, and I kept buying and buying and buying.
Minimize that guy's thing so this way we see the time.
Oh, my bad. My bad.
I just couldn't see the x-axis.
Yeah. So I bought around here, and I kept on buying, and I do specifically remember like this dip right here. So when this dip happened, it was like the day that like Microsoft said that they're going to invest more money into like their cybersecurity sector and like whatever. And everyone got scared. Like Zscaler sold off, Sentinel-1 sold off, because Microsoft is mostly endpoint security. And a lot of the endpoint security names sold off hard. Even like Palo Alto sold off a little bit, right?
Yeah.
And I just bought a lot more around there. And eventually, like I got max position, I just held it. And like this thing literally just rolled up. It just rode up all the way up here, right? To about 400. Yeah. And then this is when, you know, the outage happened. So the reason why I brought this up is because I think the cybersecurity run is just getting started. We got a few other names on here that I could bring up as well.
Palo Alto, bro, your due diligence on Palo Alto was just amazing.
Yeah, so Palo Alto did something that I didn't. Actually, let's bring up the earnings. You want to bring up the earnings?
Why don't you bring it up? Because
I mean, I'll bring up the earnings. I was just asking if you wanted to bring it up. But I mean, then again, I kind of want to go over the chart of Palo Alto real quick, because around here, dude. Wait, this isn't even Palo Alto. Hold up. Okay, here we go. Dude, I remember when it was down here. Like, I was like, I literally thought at that time, I was like, you know, Palo Alto, like I knew the company's product stuff. I just didn't do research on it very recently before that. And I was like, okay, I know Palo Alto does firewall as a service, but a lot of the way the cybersecurity is going, they're really going toward the edge, and they're really going toward non-managed or unmanaged or serverless cybersecurity, right? So I didn't buy Palo Alto, and I should have bought it at this time. And I saw this mofo run up all the way here, and I'm just like, oh my goodness, I could have been like, I knew the company too. I knew the company, but I still refused to buy it because I thought it was going to eventually become phased out. I thought that it was old technology like Fortinet. I don't think Fortinet is going to be around in like a couple of years. To be completely honest, like, I mean, they'll still be around, but I don't think they're going to be growing at a massive scale. Fortinet is really trying to catch up with innovation. What I didn't think Palo Alto was going to do was really dive into the endpoint security market. And they have mostly been SASE. They've mostly been enterprise security, which is basically encompassing the security around the entire network and around the edge on the firewall of the company. But then when you get into endpoint, these are the individual clients that you're installing on everyone's computer, and they're centrally managed in the cloud, right? So it's unmanaged service. It's basically serverless services, right? You don't manage it. So Palo Alto got into that, and when they got into it, their TAM or their serviceable addressable market is growing massively, and I think this company could be fairly cheap. We could look back at it in 2 years, and I think this company could be fairly cheap. We remember what happened when Nancy Pelosi loaded the boat, right?
Yeah. Shout out to all my spread holders, baby.
There you go, man.
That's another thing.
That was crazy. When I saw Palo Alto up here, I was like, I missed it. And then I saw they had earnings and they talked about the platformization. Everyone got scared. I'm like, how are you going to get scared about that? Like that, it's a change in strategy. You're changing your sales strategy from going to, just signing up single contract with clients for single products, whatever, growing the amount of products, landing and expanding, right? To now it's like, we're going to sell you the whole thing. We're going to give you some of these products for free. And we're going to give you time to transition from your old from your old provider to our platform, right? People thought that was it for Palo Alto because they're giving away free stuff. And it did it, dude. Like, they're still killing it. And I got to be completely honest. I remember on that earnings call, Nikesh was like very annoyed. Nikesh is the CEO of Palo Alto. He was kind of annoyed at like the way
he's also former.
He's
also former Google too. He used to work at Google, so he was an executive vice president at Google. Yeah,
there you go, man. I mean, a lot of smart people come from Google, Oracle, and those companies. But honestly, I had to get into Palo Alto at the time. We took advantage of the opportunity. We got the spreads right. I actually sold them like around here. I didn't hold on to the spread, so I just held on to the shares, and then I think I sold the shares like 320 or something. So, that's fine. Like I got a good piece of the meat. I got my money from Palo Alto. I'm good. I'm in other cybersecurity stocks. So, to be honest, like Palo Alto is a freaking winner. I do think that they're very competitive with actually let me open up I'm going to open this chart up to kind of give people a better understanding of where these companies stand in cybersecurity. Eric Flanningham, I think is his name. Here we go. Hold on. I'm just bringing up this guy's Substack because he's got he makes some damn good charts. Damn, dude. It is late.
Yeah, it is. Well, I mean, California, it's not that bad. And for me, it's 2:30 in the morning.
Yeah, that's true. I mean, you're going to be awake anyway. Let's see here. I'm going to take my time and look for this. So, here we go. Okay, that was fast. Here we go. So he's got this great chart. I'm actually going to put this article in the chat in case you guys want to read into it. I mean, this guy's good. He really does a good way of summing it up. So this is basically your cybersecurity value chain. Okay, these are different companies that are participating in cybersecurity, and this was, I think it was like a few months ago. So it's pretty up to date, right? So this is where Crowdstrike will fall into, these two sectors right here: software security, which is basically your endpoint management, and data security, which is more of like application monitoring or log management and so on. But Crowdstrike really excels here in software security. Like, they're the dominant leader. Like, they're like over 60% of like the entire market. Like, they're just dominating, right? And obviously they had an outage. Really starting to think about it, I don't know if CrowdStrike is going to be impacted that much, but we'll see when the earnings come up. Whereas here's Palo Alto, network security, and also over here you see Zscaler. Pretty competitive with each other. Zscaler is actually a much newer, more innovative company. When it comes to Palo Alto, they have been living in this space as far as a cloud native product goes for a much longer time than Palo Alto. So they are a little bit ahead of the game. The only thing is that Palo Alto is a lot more mature. They're profitable on a GAAP basis. Zscaler is not, but they are free cash flow positive. So Zscaler can really turn on the machine, sacrifice some of the growth, and to become profitable. But when you're thinking of these high growth companies, they have to increase their growth. They have to stay competitive. So they're going to have to spend the money. They're going to have to spend it in an SBC, and they're going to have to continue growing. They're basically sacrificing profitability for growth, right? And then you got this little company over here called Rubrik. Do you know what Rubrik is?
No.
Okay, so do you know what Commvault is? Okay. Do you know what Veeam is?
VM?
Veeam.
No,
okay,
man, I don't.
So data. Okay, data backup, right? So all the servers that are in your company, right? They're backed up. They're backed up probably every day, probably at night, and then a full backup over the weekend. So mostly during the week, they're all incremental. And the thing is that this data is backed up and it's stored somewhere, right? Usually it's stored in AWS S3, Azure Blobs, or GCP storage, whatever it is. And this data is just basically a backup image file and just sits there, right? Sometimes some people, they scan it, whatever, or they restore the data, whatever it is. So the thing is, there used to be this company called Commvault, where they would basically automate these backups on a virtual level, right? So you'd have before the cloud existed, there was a lot of actually, I do have my notes here that I can share, and I'll share a chart to kind of make it a little bit easier to understand. Here we go. Sorry if I'm talking your ear off, but I think it's a very good educational segment.
No, it's
for
good.
People to understand cybersecurity.
I know Dynatrace. ET FaceTime's talking about Dynatrace. I know
Dynatrace is competitive with Datadog. They're more in the monitoring portion, so it's not exactly the same thing. I mean, they might branch there eventually. So, anyways, sorry, ETF, I just didn't have the chat up, so I didn't see what you just said. I'm not ignoring you. Great. That's going to go in the AI notes. All right. So anyways, where is my chart for, here we go. Okay. So, hold on. Oh my goodness. Okay. Let me share this screen. I hope I'm not boring everyone.
Because no, I'm good, man. I'm just tired. It's 2 o'clock, 2:30 in the morning.
You're like falling asleep on me, and I'm just like, am I really that boring right now? Or are you just tired, man? All right. So, anyways, this is the traditional way that backups used to happen, right? So you had your server. Where is the server? Okay, so basically your server is kind of out on the side, right? And then the data from the server gets stored into your tier 1 storage, which is, whatever on-prem backup there is. And then another way that people did was they basically replicated the data to an alternate location. Like they would literally upload the data to some sort of alternate location and then digest all of that egress cost that they had to do, whatever. But it was the only way to do it, right? So another way that Commvault came in, they had these application backups where they automated this whole process for you on a scheduling basis, and you didn't have to worry about anything because they would just store it on their end, and you didn't have to manage any of that. So they would store these applications on disk backups for short-term use, and then they would take tape backups, which is literally like a big cassette disk, right? But it's it's magnetic, it's a lot more complicated than that, stores a lot of data. And then someone would come by every week and they'd pick up these tapes from your IT department, and then they'd ship it off site. They just store it off site for you. So there's redundancy. So in case your building blows up, your data is still here, the company doesn't go out of business, whatever, right? So that is how they really used to do backups back then. Some places still do that, ironically. They legit still do this archaic method or legacy method of backing up data. So the way Rubrik works is that, again, Rubrik is a cybersecurity company. They are not a data storage, data backup company. That's what they do on the surface. That's their core product. But the cybersecurity comes in. I promise I'll talk about the cybersecurity at one point, all right? We just saw the viewers go down about 10% there, but that's cool. I'll keep going. So what Rubrik does is that you have your on-prem data. When I say on-prem, it could be an Amazon, whatever it is. You could have your Amazon data, your EC2 instances, your RDS instances, whatever it is. You could have your Azure data, your Azure servers, whatever. You could even have your own on-prem stuff in Arizona or something, right? Rubrik will take the data no matter what it is, and they'll back all that up for you and then store it for you. And then on top of that, they will be able to scan this data that you have to make sure that there's no viruses or there's no malware, ransomware, whatever it is. And ransomware is a pretty big deal. Ransomware is basically when a hacker takes your data, encrypts all of it, and says, I have the key to all of this data and you can't access it. So you need to pay me. You need to pay this ransom of like 20 billion 20 Bitcoin or something to this account. And then I will unlock that data for you and you can go ahead and use it again. And guess what company this actually happened to recently?
Who?
United Healthcare. They had to pay a very
damn.
big ransom. Yeah, they had to pay a very big ransom to get their data back. This is probably one of the most unspoken problems that these IT companies are coming into, because it literally doesn't take like anyone to penetrate a firewall. Like it could just be social engineering, dude. Like I said this on Ahmed's stream earlier, where it's like you could literally have someone who somehow gets to the building, talks to Darlene. Darlene's a very nice lady that sits in the corner in the IT in the accounting department, does the paperwork, right? Very nice lady. Guy helps her out, say, oh, you'd like some coffee, Darlene? Oh, yeah, sure. Thank you so much. Yeah. Oh, by the way, I work in the IT department. We're just going through some routine checks. Do you mind if I just jump into your computer quick? Oh, yeah, sure. Oh, Darlene, what's your password? It seems to be locked out. Oh, my password is password 123. It's on that post-it on your desk, right? So this dude goes in there and he now is in your network.
Yeah.
He can literally do whatever he wants as far as whatever access Darlene has. But literally once they're in there, that's all they need. They'll figure out the rest, right? So this is really becoming a major problem in a lot of companies. When someone holds your data hostage, most of the time they have no choice but to pay you just to get rid of you. A lot of companies doing, they don't really say anything about it, right? What Rubrik
their insurance companies just advise them to pay them off because this way it's cheaper to
sense. Yeah. Sam, this impressionist. Yeah, can you believe that it's 12 a.m. over here and I'm still have the energy of a teenager? Anyways, so what Rubrik does is that they take this data that you backed up, or actually, let me see if I have another slide about it in here. No, okay, so I'll just bring this back up in the meantime. Oops, no, not that one. This one.
They just went public,
so
right?
They just went public last May. They've actually been around since like I think around 2013, 2014. So anyways, I'll get more into the financials, the fundamentals in a second. So Rubrik, what they do is, like I already said, their core product is that they back up all of your system, no matter they're cloud independent. So they're multi-cloud. They can be whatever, even on-prem, whatever. They'll back up all your data into their platform. You can access everything, automate, whatever it is. The cool part that Rubrik does is that the data that they back up for you, they scan it ahead of time to make sure it's good. So that way, if you do run into a ransomware problem, you don't need to pay this company the ransom to get your data back. Rubrik will just take one of the clean backups that you have to the point where it's clean before the ransomware happened, and they'll just restore it real quick.
That's cool.
And
that's awesome.
This will literally happen in like 2 hours, like not even. It depends on how long it takes for the data to get there. And usually with the ransomware is that they're not going to like encrypt all the companies. They'll just encrypt like a domain controller or like one of the important servers in your company. Like they'll target it and they'll say this, and like, you could just restore it on it. And since everything's in the cloud, you could like literally spin it up probably in like a few minutes, but it's something that takes like an hour because, it takes everything to connect to it, whatever, DNS, whatever. So this is the benefit of Rubrik. And the thing is that this isn't something that they kind of figured out, but the fact that they are cloud native, like they were built for the cloud, right? And they're already cloud independent. They're like kind of the NVIDIA of this type of technology, right? Of backup, replication, archival, analytics, all that stuff. There's a lot more to the application, but this is their edge in the system. And the fact that they're already ahead of everyone. So that is what Rubrik does as a whole. And the good part is that the CEO of Rubrik, I believe, actually, let's see here. The CEO, he used to be an IBM. He used to be part of Oracle as well, and so on. The interesting part was that one of the independent directors that's on the board, he actually used to be the former chairman of Microsoft. The former chairman of Microsoft, right? Also, he used to be the former chairman and the CEO of Symantec. You've heard of Symantec, right?
Yeah.
It was like one of the legacy backup and endpoint protection companies. They've been around. They're still around actually, but they're just not as popular. So this company is actually backed up by they're backed by Microsoft. So that already speaks a lot of volume and everything. Also, what was the name of that company that Frank Slootman, the VC that he used to be a part of?
Data domain. Not data domain.
Oh,
Greylock.
Greylock
Greylock.
Partners. They backed this company up. But most importantly, Dell did acquire a company called EMC recently, and that's where Frank Slootman became very popular, because he used to be the chair and CEO of EMC. And the thing is that you got some pretty heavy hitters in this company, right? And even the CISO, the Chief Information Security Officer, he used to be the CISO of the CIA, right? So you got some heavy hitters in this company. Now here's a caveat. All right, set all this stuff aside. This is a cash burning company. Like, they burn cash. They're still in very early.
While you were doing that, that's the first thing I did. I was like, okay, let me take a look at their financials.
No, I'm gonna tell you straight up. Go ahead, share your screen. Share your screen.
Yeah, hold on 1 second. I was like, okay, let me take a quick gander at their financials.
Yeah, you got
on a
risk,
TTM basis. Their operating revenue grew only about 16% year over year, but their selling and administration was almost $1 billion on a TTM basis, and the research and development was about 400. But I'm guessing this is like the cost from the IPO, not necessarily like a standard thing, you know. So
yeah, I mean, they had to incur a lot of costs, so you see a lot of that debt in the balance sheet.
Yeah,
you saw, like,
so
the numbers were kind of screwed up, to be completely. Oh, go ahead.
So you look at the data right here, and this is the telling thing. So a lot of people, what they'll do is they'll look at the net income, be like, oh my God, look at these guys, they're losing so much money. Net income, they lost $1 billion. Oh no, I would never touch it. But if you look at it on a cash flow basis, which is more important in my opinion, most of that came in the form of stock-based compensation due to the IPO. But once again, once the IPO is done, that's going to moderate to something that's more historically accurate like this. And if they're able to kind of grow their top line, they could do really well for themselves. You know, they could.
I think they're actually projected to be free cash flow positive in the next couple of years. Don't quote me on that though, but they did kind of give like an estimate of when they're going to become free cash flow positive. But you know, the risk with a company like this, and I do have a position in it. My average is about, I think it's like 30.49 right now. I did continue to add to it, but I also added to it heavily when I initially started a position, and it's not a big position. It's like 1.5% of my portfolio, so it's not totally that big. But I think it's a good fringe play. In the cybersecurity sector, get a little bit of diversification. I do have Sentinel One. Sentinel One is they're a pretty big competitor with Microsoft and CrowdStrike, and I do believe that they're going to continue to gain more market share. But again, this is cybersecurity, man. The cybersecurity TAM is just going to be growing exponentially. Like, they haven't even talked about infiltrations, or they haven't talked about like penetration using like AI, right? So
do me a favor, after you're done with this, run a model for 2026 with these numbers, the 1.3 billion in revenue, because I mean their current market cap is about 7 billion. Their gross margins are probably like every other SaaS company in the 80-90% range.
So they're about to be $1 billion in ARR.
That's really good.
Right?
Yeah.
And they're still growing. Really good. They're growing, I think, at about 37%.
Yeah. 30
as of last quarter.
Yeah, they look like 30%. Yeah.
$1 billion ARR, 7 billion in revenue. I mean, 7 billion market cap. I don't know, man. Like, it
should
seems
double.
like a pretty
it should
good.
Be double.
Yeah,
it's easy.
Like
I think it's an easy double.
Yeah,
it's easy.
I'd say it's probably when interest rates get. See, now this is the thing, is that when interest rates come down, which they are coming down, the market's already front running it. Is that you have these small cap companies, right, that will excel, that are doing very good in the industry, because people like money managers, they don't want to buy IWM, they want to buy smaller cap stock. They want to have risk exposure, and when you think of cybersecurity, man. That's I can't really think of a 2-gauge shotgun or something. I don't know, but that's a good thing right there, right? That's I would say it wouldn't be bad to position yourself in some small cap stocks, not big positions, but just little ones, because it really doesn't take that much for these small cap, for 7 billion market cap small cap stock to move. If that doubles, it's only 14 billion, which isn't a lot, especially at 1 billion ARR. So
here's a question:
cybersecurity.
Do they have? You think that this moat is durable for them? That it's something that's not gonna. I mean, I'm looking at their Magic Quadrant too,
They
and they're
have
literally
competition. Yeah, they have competition.
Yeah, the good thing is that
yeah.
The good thing is I'm looking at their Magic Quadrant. So let's take a look at you. Let me just
You want
bring
to
this up. Yeah. Share screen. Window.
Thank you for everyone who's been sticking around. Actually, there have been like 40 plus viewers constantly this whole time. We're at 38 right now, but things like fluctuating. But thank you everyone for being on very late. I'm actually pretty surprised. We had a pretty decent turnout for like the middle of the freaking night.
Yeah.
Thank you. If you have, yeah. Oh yeah, actually that's really good because we do have a good amount of people, a good amount of audience in Europe. So it's cool to have them see us live for the first time ever.
All right. Can you see the screen right here? Can you see the screen? Okay.
Yeah, I just added it.
So you can see that these are the main players in the what is that, enterprise backup and recovery space. It looks like Rubrik is literally at the top.
You want to make the actually, why don't you right click that and do open a new tab?
Oh yeah.
Oh, there you go.
Can you see
it?
Or
that too. Yeah. Yeah, I can see it. See, there you go. There's Veeam, there's Commvault, Rubrik, Cohesity, Veritas. Veritas.
You don't have to disparage them.
I don't think that they should be all the way up there to that. But okay, fine. Cool, they're up there. Yeah, Rubrik is the leader. Commvault and Veeam, of course. Veeam actually did. They were one of the major players probably like more than 10 years ago because they were more virtual native per se, which basically they ran on like Citrix farms or VMware servers and stuff. So they were native with that. Commvault is the one that's been around for a while. They're like the Palo Alto. But no, actually, no. Veeam is like Palo Alto. Commvault's like Fortinet. Rubrik is Rubrik's CrowdStrike, baby.
Yeah. Okay.
Cohesity. Go ahead.
No, this is definitely worth looking at, pursuing, man. I mean, if they're ranking this high on the Gartner Magic Quadrant, they just went public. I'm sure that over time, all these other people are going to recognize the value. And especially every time that there is a ransomware attack, that just provides that specific company an entryway into the ecosystem for them as a sales target. And then what ends up happening is because they get hacked, usually the entire industry moves in that direction. So like healthcare right now, if one hospital gets attacked like this and ends up getting, they all kind of switch. So I think it's worth looking at, So
man.
Thanks for bringing that up. That was good.
No problem. I'm already in it, as everyone says. Not a big position, 1.5%. I have a couple of options on it, but like, just like FU money. Like I'm not even trying to get rich off of those. But yeah, man, shoot. It is almost 12 a.m. here and I got to wake up in 6 hours. So we'll see about that.
All right. Enjoy.
Cheers. What is that? Vodka cranberry? No, just kidding. Just kidding around.
It's Red Bull vodka, but what I do
is
I dilute the shit out of it so that this way I can drink it. Because drinking Red Bull straight is not for me, bro. I'm an old man now, so I can't do that.
Yeah, that for me, if I had one of those, I won't be able to fall asleep.
Yeah, I need to be awake. Yeah. So yeah. All right, thanks everyone for sticking around.
Yeah,
this was good. If you haven't already hit the like and subscribe, please hit the like and subscribe. We are trying to get to 1,000 subscribers sooner rather than later. So if you could really help us out with that, that'd be awesome. And if you're not on the Patreon, if you want to join, there's a link below. Join the Patreon. It goes towards helping us not work extra 2 jobs to make ends meet, especially Sam and his California.
Dude, I would love to do this full time, man.
I know.
It's just so much more interesting than working.
I know. We'll get there. We'll get there. It's going to take some time, but we'll get there. So,
yeah. And I am fairly new to the whole streaming scene. Kris, you've been doing this for a while, but I still remember the first day when I met you on the on one of those inner circle. That's a benefit you still have for the inner circle to meet you one-on-one. And I was like, oh, like so starstruck, man. Like I see you all the time on camera. Like, please, can I have an autograph?
I'm some asshole, bro. I'm just some asshole.
That's just some asshole working in Atlanta. Like it's just
that's it. I'm just some asshole who's basically figured out, like, okay, up and to the right, good, up and to the right, down.
Yeah, that's like the whole thing is that we do have the benefit of not running like billions of dollars, or we can't just jump into one stock if we feel like it. We don't need to worry about massive liquidity like an Apple stock and Apple options and stuff. Like we have the edge right now being as retail traders. So like, let's not buy stuff that everyone is talking about on CNBC. Let's do the research. Let's look for these good companies. Let's figure out, is it a good time to buy it? Let's combine technical analysis with fundamental analysis, qualitative, quantitative, all that stuff. And that is how you get real edge, man.
Yep.
And you're the one that came up with the title too. Hidden Edge. Yeah. You're the one that came up with that one.
I'm hoping, dude, we're supposed to get this logo. This person from Fiverr is late. Okay. You will see a new logo soon. But I've been working on it for like the last couple of days. So hopefully
he just woke up. He's in India, probably. He just woke up.
Oh, wait. Delivered. I will share it live with you guys. Bro, it looks freaking good.
Wait, don't share it live because we're going to copyright it. Lucy Picker is going to steal it.
No. I'll share it on WhatsApp if you want to share it on your screen. 1 second, I'll show you guys.
Yeah, go for it.
I'm not going to approve it yet because this is like a first draft, but
ETF FaceTime is going to copy it. He's going to make his new logo. You're going to see it on YouTube. He's going to start a podcast. Steal it. He's going to steal it.
It looks really freaking good, man. I like it. But like I said, it's up to you. There we go.
Oh,
right, it's pretty good, right? Come on, man.
Dope. Dude. I'm not going to share it. I'm not sorry, guys. I'm not going to share it. You'll see it.
Share it. What the hell? People are going to see it anyway.
I don't want to share it. I know the people here are cool. But when you got those Chinese algorithms swift
it's
into
30
YouTube,
people who gives a shit.
No, but I want to have the big reveal, man.
The big reveal is right now. Just show it. You know, it's a freaking cool thing. There you go.
Fine.
Lucy Picker's like he's got the STRG coffee ready. Control Shift C. All right.
What's STRG?
I think he meant Control Shift C. I don't know what that
it's probably
is.
some crazy German keyboard or something.
Yeah. There you go. How does that look?
Right. I love it. And you did the blue.
Yeah.
You're my boy, Blue. You're my boy, Blue.
There you go.
Perfect. So I love it. Okay, that's it, guys. Nice. That's all you're gonna get. Wait, would there be a copyright on it? No, there's no copyright on it, man. Don't do that. Yeah. No, that's dope, man. That's dope. Let's Capital.
Okay, so you approve. That's gonna be our logo. So I'll let the Fiverr person know. Cool.
Here's $5.
Approve. I mean, I could tip them, but I'm gonna give them
here's $1. That's a 20% tip, man.
Yeah.
Right. Really I gotta go to bed. My wife is probably gonna like wake up and like yell at me.
Okay. Have a good one, brother. Take care.
All right. Thanks for coming, guys. Oh, yo, what's up? I don't even know who this guy is. I don't see him. Yo, what's up? Thanks for coming, man. All right. Later, guys.
Yep. Take care.
I'll just end the stream.
Yep.